Good morning, everybody. Ryan is having a few issues. Hopefully, he's going to join us in a little while. I must admit, I'm not terribly well prepared for today, but I will do my best. And maybe when he comes on, he's going to talk about in terms of headlines and data and stuff. So let me, okay, let me share my screen and start. So first of all, the main news was, by the way, can you confirm that you can hear me okay, everybody? Anybody just type in the chat? You can, okay, perfect, thank you. Let me get rid of this. So the main event was, surprise, surprise. Oh, damn it. I'm not gonna answer that. Okay, so hold on, sorry, I need to write a message to the person who called me because it's important. Okay, debt ceiling has been passed through the House, Congress, everything, and I'm sure you're all as surprised as we were. I'm kidding. There was no other way, really, and it's been passed, and everything is now nice and dandy. We've kicked the can for a little bit more, and you can be sure that they're going to kick it again and again and again. You know what, this was our base scenario. Obviously, we've been talking about it. We've been saying that it's all theatrics and negotiations, and it looks like this was the case once again. And because frankly, if the debt ceiling is not raised, then the US cannot fund its deficit. As simple as that. You know, as long as there's a deficit, debt has to go up. There's no other way that they can fund it. So what has the market done? Actually, we'll talk about markets in a little bit. News-wise, this was the main event. We have more and more Fed speakers talking about, oh, I think I hear Ryan.
Yeah, hello, hello.
Oh, hello. How are you doing?
No idea. The internet decided to go down on me.
Okay.
Back up now. So go on, you carry on and then
Yeah,
we'll pick it
no
up.
problem. We got more Fed members effectively indicating that the Fed's going to pause, but we should not misconstrue this as a total pause because they might start hiking again. I find that quite unlikely, especially since inflation is still on the downtrend. And I've talked about this at length. The Fed and other central banks are always going to find a reason to be less or more accommodative than maybe they should, but they're always going to find a reason. So, in my opinion, if a pause comes, I think it's the end of the cycle. It's a similar story with the ECB. There were a couple of was it Lagarde, I think, yesterday, or somebody else? I can't remember exactly who it was from the ECB.
Yeah,
Was it Lagarde who said
yeah.
that the hikes are starting to take effect into the economy? We're seeing inflation lower, so effectively saying we're doing our job as well as we can, and it seems to be working. Many people would disagree about the pace and the timing of what they're doing, but inflation is coming down. So in that respect, they are having some success. As I said before, Ryan, I'm not really prepared there in terms of news and headlines. So
I can jump back in if you want, if you're all right.
okay, yeah, that's fine.
Yeah,
Thank you.
no worries. Do you want me to grab the screen back quickly?
Yes, please. Yeah,
Yeah, will do, mate.
because I actually need to take a call in the next minute. So I'll be here, but I'll be speaking on the phone. So you can take
Yeah,
over, and I'll be back in 2 minutes. Okay.
no worries, mate.
Thank you.
Can you see that okay?
Yes, perfect.
Wicked
Thank
stuff.
you.
Cool. Well, I'll start again for myself. Good morning. A little bit of internet wobbles as we typically about 30 seconds before the show starts, it all happens. Anyway, back here now, so I'll get going before, just in case I get cut off again. So we'll start with China, and a story just out not too long ago that they're going to weigh some property market support packages to boost the economy. It's not exactly new news that they're doing this, and particularly what's been going on in the property market itself. We know there's been big issues there, but it has given a little bit of an extra leg to the fall in dollar China that we've had over the last day or so. I'm not sure how fiscal stimulus is, which is easing, leads to the currency strengthening, but I guess that's the market putting 2 and 2 together and saying, well, it means that there'll be a stronger economy and thus a stronger one. But I don't subscribe to that thought just yet. But we have seen a pullback in dollar China, not quite getting down to levels where I might consider getting back into longs, but we shall wait and see, and we'll look at those prices in more details. But on the one, and this is probably more behind the move that we've seen today, is that China's Commerce Ministry apparently has surveyed companies on the impact from a weaker yuan. So they've had a little ring around to say, you know, what's people's exposure, how's it impacting imports, exports, that sort of thing. So that is another mild torpedo in terms of which way the currency's been going of late. And as I say, that's probably more behind this dip in dollar China at the moment, the fact that there's officials keeping a closer eye on the impact of a weaker yuan. It's not, doesn't mean it's a brick wall at the moment, but every time we get these little bits of comments coming out, it tends to make the upside a little bit more harder. So going to be keen to watch if we do get a rally back towards those highs, if it runs into trouble up there, because the market's sensing there might be a change coming. They fixed the reference rate at 7.0939 last night, which is little changed from the 7.0965 previously, though that was below where we've been trading. We've been trading up above the 710, so they were fixing well below that at the 709s. So they might be looking to put the brakes on, but obviously that's changed a bit now with this price move. Over to the Bank of Japan, and Ueda says it will take some time to reach the 2% price goal, and he can't say when that 2% goal will be reached. The trend in inflation is likely to heighten ahead, but it will take time. The BOJ was unable to reach its goal as soon as possible, which was sort of part of its language previously. Raising potential growth rate is a key issue for Japan, and the bank expects CPI to clearly slow towards the middle of this year. It's not the time to yet debate a specific exit policy or strategy. So you're either giving with one hand, taking with the other. Some comments previously have been a little bit more on the hawkish side, talking more about an exit. Now he's just winding those back in a bit, keeping the cautious tone and the as we are tone as well. So just part of the communication game that he seems to be playing. Doesn't want to give too much, takes 2 steps towards the exit and 1 step back, which is going to be the slow and steady way that they do things. According to the Nikkei, the foreign buying of Japanese stocks is continuing for the 9th successive week, apparently, and that's even having investors dipping into lesser known shares. So rather than staying on the main indices and the big companies, foreign investors are looking at buying a broader range of shares in Japan. So it's something to keep an eye on regarding flows, particularly regarding the yen, of course. For the RBA, they're next week, and 21 of 32 economists forecast the RBA to hold the cash rate at 3.85% next week, but with another raise later. Now the balance, the other 11, all see a rate hike coming next week. So the majority favour a pause, but a hike later, but a good chunk still think that they might hike next week. So it's a bit of an open book for that one in the RBA next week. Over to the ECB, and as Stell mentioned, the wafflers coming out, Lagarde being one of them. This was after the inflation data. She said inflation is too high and set to remain so for too long. There's no clear evidence underlying inflation has peaked. Hikes are already feeding forcefully into bank lending conditions. but we need to continue our hiking cycle until we are sufficiently confident that inflation is on track to return to our target in a timely manner. We cannot yet say that we are satisfied with the inflation outlook. So a bit of a repeat, or I think I mentioned those comments late in the show yesterday, but again, brushing the inflation drop that we saw this week under the rug a bit and saying they're going to need to continue hiking. ECB's Kazakhs, one of the big hawks, says it's hard to say where interest rates will peak. Rates will stay at their peak for a while, but he says the market bets on peak ECB rate may not be far off the mark. A lot of the market looking at potentially 1-2 more hikes from the ECB, and outly a third hike in September. So getting close, he thinks the market is to price in those numbers for the ECB. Meanwhile, ECB's Villeroy is already on the victory laps, saying we are well on our way to beating inflation. We will bring inflation to 2% by 2025. Upcoming rate hikes will be marginal. So declaring victory in France. Who would like to see him get a slap round the face regarding those forecasts? Anyway, ECB's Panetta, inflation is too high.
I'm not sure if you were looking for me. I'm back now. I had to take a call. So did you ask for me or not?
No.
Oh, you did? Okay, good. You don't need me. Okay, good to know. Well, I am here now.
No worries, mate. One sugar, please, mate. Yeah, ECB's Panetta said that inflation is too high, but there is no reason to worry. Don't think this is the time to be too hasty in raising rates. ECB's F.A.C.E says further ECB hikes are needed to reach the goal of 2% on inflation. We also got the ECB minutes out yesterday, and it was reported that a number of members initially expressed a preference for increasing the key rate by 50 basis points at the last meeting. Initially expressed a preference. Obviously, they expressed that preference, then decided to go with the 25. There was a strong preference against returning to outright forward guidance. That is when Lagarde previously told us we were getting 3 hikes on the bounce. And the March inflation outlook was judged too optimistic. A little bit of another dig at star forecasts on that one. Over to some of the data that we've had out. Going back to yesterday's numbers in the US, and Challenger job cuts, this is layoffs, had a pretty big jump to 80,000 from 67,000 previously. We are seeing a bit of a pickup now in these job cuts coming in. The tech sector held the bulk of them again, which we pretty much know about, given all the headlines regarding that sector. But things are picking up in terms of layoffs. Now, these job cut numbers don't necessarily mean those people are going to be made redundant or going to lose their job. It's an intention to lay off. So some people can get repurposed, so on and so forth. ADP added that wage-driven inflation may be less of a concern for the economy despite robust hiring. So we've had a couple of Fed members looking at the wages data, saying that it's not showing any signs of getting too hot. So that's something that they keep an eye on within the jobs market. ADP, big surprise number, 278 versus 170 expected. So the market now again thinking that things are going to be strong for the NFP today. Obviously, it's not a direct link, as we know. The NFP can be vastly different from the ADP, but still, it's been dropped, and the market is going to move on anyway. Now, what was surprising, which you'll know if you were watching F.A.C.E yesterday, is that the dollar initially popped higher on that, and then got slammed lower. That is a theme we need to watch out for today. The market is flipping to Fed pausing at their next meeting. That's what we're trading going into the NFPs. I don't think even a strong NFP number is going to change that. The market is playing the inflation card. We saw from the ISM, from the other PMIs, notes and comments that price pressures are easing. If we look at that ISM prices paid number, 44.2, it was expected to only dip to 52, stay in expansion, so it's gone heavily into contraction. The same can be said in the S&P Global Manufacturing PMI, where it registered its first drop in input prices in 3 years. So prices not gaining less, but actually dropping. And the market has picked up on those, as well as those Fed speakers potentially indicating they're going to vote for a pause in June. We know we flipped from pricing hikes to pricing a pause early this week. So regarding the NFP, I think if we get a strong jobs number and we see the dollar rally, I think that's going to get hit. The only counter to that, and let's bring it on to today's numbers, you can see, the only counter I throw up to that is the wages number. I think this might be bigger than the actual NFP number. If it's a big, strong reading, if it's, getting up to sort of 5%, that is potentially going to flip those Fed expectations again towards the hawkish side. I don't think the non-farm number matters too much, even if it's a big number on the upside. As I say, the market probably reacts as it always does, but we're going to be looking at the other components. Because what the market is seeing now, as I say, going in, it's sensing a turn, it's sensing a pause, it's pricing a pause. The only thing that will change that pause is if the average hourly earnings jumps much higher. If they come in softer, that's going to cement a pause. So even if we get a 500k NFP, if those wages drop to 4% or less, the market's going to trade those, not the big number. So going in, I think we're in for the dollar rally selling mode at the moment. So I'm potentially going to be looking for a rally on good numbers to sell into, as long as it doesn't come with those higher wages. So that's what I'm looking for going into the NFP, and I'll bring Stelios in a moment to look at that. But just going back to the data quickly, as you can see there from the ISM, we are seeing a bit of a divergence now. Prices coming down, but employment remaining strong. Was expected to fall into contraction. It went further into expansion. So this is the perfect storm for the Fed, or the perfect outcome for the Fed. They're getting lower prices, but it seems there is no damage to the jobs market at the moment. If they get that it gives them their soft landing, where they don't see the jobs market collapsing or rates are not impacting the jobs market. So we're back into talking about a soft landing again rather than a hard landing. The other side is that obviously the manufacturing, as we've seen elsewhere, is looking a bit crappy. So that's going to have an impact again on commodities, again on economic activity, though not as much perhaps as services. So we need to keep an eye next week for the ISM non-manufacturing number to see how that's going to play out. I'm not sure what day that is, but we'll look at that next week anyway. So just looking on some of the other headlines, Canada data as well. That was a little bit weaker than expected, coming into contraction as well on manufacturing at 49 versus 49.4 expected and 50.2 previously. Fed's Harker was out again saying they're close to the point where the Fed can hold rates. Prudent policy is to skip a rate hike in June. He sees significant room for improvement on inflation. Fed's Bullard says monetary policy is now at the low end of what is arguably sufficiently restrictive given the current macroeconomic conditions. This was a paper, an essay as he liked to call it, that he put out yesterday, giving us where he thinks restrictive rates are. He thinks they're at the low end of a band that runs between 5 and 7%. So at the bottom end of that. So in his terms, probably got more to do on that front. We're over the debt hump at last. The US Senate cleared the debt deal. Off it went to Biden to give the old rubber stamp to, and it seems we're over that now. We can put it in the rear view mirror. What we have to look for now is how they refill the coffers of this TGA account and this emergency measures that they implemented back in January to pay the bills. The Treasury issued a statement yesterday, say they are delaying next week's 3 and 6 month bill sales due to what's been going on with the debt cap, but they are planning to upsize sale of both of those by 2 billion apiece. So it's a slow and steady refill, if you like, of this account that they've been using to pay their bills. A lot of the market thinking that it might be a bit of a rush job and they might put a lot of pressure on liquidity in the market, issuing far more bills to top up the account again. But they've only gone 2 billion extra on each of those 3 and 6 month bill sales. So not a huge amount. Funny talking about billions as not being a huge amount, but in terms of the bigger picture, it's not even a 10% increase. So they've got until 2025, if you like, to refill this account. So there's no need to rush into anything there at all. They'll give us more of an update on bill sales on Monday. Right, so the big deal is going to be the NFP today. Stel, what are your thoughts for it? Think we're going to get a strong number? And what was your guess, by the way? What was your guess on the?
My guess was 169. So after yesterday's ADP, I'm not feeling too comfortable. Well, the trend has been we've been getting good numbers in terms of employment recently. So I don't know. It's a lottery, man. Seriously, and we have to look at the revision as well and everything. It's a lottery. I don't know. I mean, I went for 169, but after yesterday's ADP, I think it might be a little bit above expectations. But who knows? But what I want to say is that I'm really shocked that the debt deal was signed. I mean, weren't you? No, but I mentioned this at the beginning. It's all done and dusted, and I really find it really interesting how the market always overreacts in when the time comes to raise the ceiling again and again and again. And yeah, but anyway, what do I think about the data? I think the average hourly earnings are going to be one of the things to watch. That's the number I'm going to be watching first. Yes, the headline payrolls number is important as always, but we know that employment is going to be robust. That's a given now, and that's what the market's pricing. And the unemployment rate around 3.5%. Who cares? It's all good on the employment front. The problem is prices, inflation. That's always been the problem. That's why the Fed has been hiking, and that's why the Fed will stop and will start cutting when the time comes. So that's where I'm putting my focus on, and I can bet that's what the Fed look at. I'm sure they look at employment as always, but it's almost like it's on autopilot. So anything that has to do with prices, and good example was yesterday. You mentioned the numbers yesterday. ISM manufacturing prices came in well below 52 expected. I mean, well below, and that's what's going to be driving inflation. Of course, it's not an immediate effect, but you get enough of these numbers, these leading indicators, they then feed through to the economy and they feed through to the prices that we're seeing. And I think it's not surprising that we're seeing in Europe and the Eurozone, you're seeing negative year-on-year rates for PPI and for all sorts of price indices. And I think that makes a lot of sense. They have to eventually come back down a little bit. I'm not saying they're going to go back down to where they were 2 years ago, but the rate of change on an annual basis has to come down, at least to where theoretically the Fed's target is at 2%. It really should go below it. I don't think it will, but I think that's only a normal effect after a year and a half of rapid expansion of prices. And unless there is, for some crazy reason, an amazing boom in the global economy and everything's doing great, people spending left, right, and center, I think unless that happens, year-on-year price metrics are going to go back towards target and maybe below, towards zero. They have to go negative theoretically. So so for today's numbers, to cut a long story short, I'm looking at the earnings number probably a little bit more than payrolls.
Yeah, exactly what I said earlier. I don't know if you was on your call then when I said it.
But you did. Okay. Yeah.
Yeah, absolutely right. That earnings number is going to be more important than the headline number. Now, just for good order's sake, I've gone for negative 153, I think, for the NFP. For the sole purpose, I've used extensive models and calculations, i.e., I'm just having a guess. And everyone's looking for a plus number. Everyone's ramping up expectations after the ADP. I'm just going to be a contra and go the other way. So yeah, I'm going for a negative 153. So yeah, watch out below. But in terms of the numbers overall, so just to go over them just quickly once again, what to look at, how to assess the different numbers. So we've got the headline number, obviously the first thing everyone's going to watch at, and in this case we're going to look at wages, but then look at the unemployment rate, see what happens there. Is expected to tick up to 3.5%. When you look at the unemployment rate, you've got to look at the participation rate, because this tells you how many people are coming in and out of the jobs market. So if the participation rate rises, that means there's more people looking for work. So they're out of work, but looking for work in the jobs market rather than being out of the jobs market. So higher participation rate can lead to a high unemployment rate. So that doesn't necessarily mean a high unemployment rate number is a negative. It means there's more people looking for work. What is positive is if you get a higher participation rate and a lower unemployment rate. That means more people are coming in, but more people are getting jobs. So that shows good strength in the jobs market. So whenever you look at the unemployment rate, you've got to see what happens with the participation rate as well. So that's that for the data. We've all got expectations in. I've just put a link to the competition if you haven't entered it already. Obviously, you can win, or 3 lucky people can win a free month on our ForexAnalytix platform. If you're already a subscriber, that will just get added on to your current subscription. What about my dollar yen short, says Ali. I'm out my dollar yen shorts, mate. I'm not in them, and I'm holding fire for now. I am getting a little bit itchy to maybe get back in again. I was thinking along the same lines as Blake and Stell in after getting a debt ceiling resolution. We would perhaps see some downside pressure. I think I'm going to be looking at least for this NFP. If the numbers come out the right way and we get a decent rally, I might sell some dollar yen. Not so much as a long-term trade, just to play the levels, play the sentiment at the moment, and just see where it goes from there, rather than build a big, huge position or a longer-term position. So we'll start there with dollar yen. Because what it's doing is playing nicely with the techs. You know, we had this grind up pretty much since the end of March. It's just been on a grind, in particular second half of May, where it really hasn't dipped back at all. It's really been on one of its long grind periods, but it looks to have broken that right now. We've got a bit of a short-term double top up into these high 140s. It is stepping down a bit. We had a prior level here, 140.60s, and immediately after that last high, that's where it resisted. Then we couldn't get up as high. Then we broke back below 140, 139.90. That's become resistance as well now. We've dipped under 139, 139.10. You can probably draw it down a bit, as I said previously, to 90. We're now holding under that area. The big level obviously below is the 138. That was the big old level that we were watching, and if you remember, we found a bit of a range there sitting at that 138. We had these prior highs, we couldn't get through. We had little pokes above, couldn't get through, and then we finally got the proper break. So 138 is your big level down below. That's going to be your marker for this rally. It could go one of either way, as I said, over the NFP. So I'm not going to guess. If we get a move back up to 140, and I like the NFP numbers, and maybe it's just a move on the headline and the wages are a bit weaker, I'm going to look to maybe fade that move up into 140 or wherever it goes. That's what we're looking at there. As for dip buying, I'm maybe against the 138, but again, I'll assess why we're down at 138. If it's because wages have collapsed and the NFP number's bad, I probably won't touch it, because that's just going to, as I say, further cement a pause from the Fed and maybe extend that out to future months as well, and that will have the market thinking we're at the end of the hike cycle. In that case, I don't particularly want to be long dollar yen on that basis. Looking at the euro dollar as well, I had previously, we had this big zone 107 down to 105 that I've been talking about, and we had some intermediate points in there. We hit one of them, 106.30s, and we've bounced. We've got back above the 107, which is a strong signal in the first instance, got back above the 107.60, and we're trying to hold it. So it's looking a bit constructive for the euro now. It's getting back above its levels. It's holding the breaks back up. Still a lot of work to do to undo, obviously, a lot of this move from the 111s, but you've got to start somewhere. And we've been talking about price action this week and what you want to look for. You want to look for the breaks and the holds. We're breaking and we're holding. Now, for now, I wouldn't pay attention to this. I wouldn't put too much faith in it because we're, 2.5 hours away from the NFP. This could be anywhere after that. It could be up through 108 or it could be back down to the 106s. So while we've had a decent move on this, if you're in positions, if you're in longs from the bottom, well done. But you might want to think about taking some money off the table. You don't want to see all your good earnings given back on a really strong dollar number and all the way back down here. So it's always wise to take some money off the table. If you've got some good margin in it, you can always leave a little piece on to play with over the numbers. But otherwise, yeah, we're making good progress, but a lot of work to do still. 108 is the next level, 108.30 after that. Dollar CAD, we've been keeping an eye on as well. Well, it seemed to me only a couple of days ago, earlier this week, we were talking about maybe having a look at the upside and testing up at the 138s, and how it seems we might have more chance of testing the downside. Down into the 134 area is a bit like the 136.50, though perhaps not as strong. So keep an eye on that one. We're still looking very bearish in this one, even as oil stopped rallying for the moment after the rally from yesterday. Down into this trend line, 133.20s, and then the big 133 where we found prior support. That's going to be a big area. If we get down there, I'm going to be looking at that for at least a tech long, maybe starting from the 20s, run it into the 133s and a stop below those prior lows there. Again, I'm going to judge the numbers as they happen. But as we know from the Loonie, it likes to play nicely sometimes with the techs. It did at 136.50 the other day by 2-3 pips. It held that area, and look what it's done since then, over 200 pips lower. So nicely, nice moves there for that one. If you're trading the Loonie, cable. Still, did you talk about cable when?
I did not. No,
you did not. Okay, so no. We can have a look at that one as well. I said this one is likely to play between the big figures and half figures. 124, it's held. 124.50, it held and broke. 125, it pretty much sailed through, but here we are, 124.50, and we're finding resistance. So it's
25.50.
25.50. Yeah. So this one, you can pretty much play the big figures and half figures. That's where the levels are showing up. This one again has got the potential to rally on soft data again today, and then maybe we're looking at 126 and these prior highs up here. If we get up there today, it might be a decent stretch point to maybe think about just a tech fade off the top. But we know that there's a strong wind behind the pound at the moment over the last couple of weeks. So be careful if you are trying to pick tops in this one. Let the text do the talking. Let's have a look. What are you into today, Ali? I know you're in something. I think I saw it earlier. You're long Kiwi. Very nice. Very nice. Let's have a look at the old Kiwi. 691. So just above this old support zone here, or bit of support resistance zone, not a strong one. Obvious where the resistance is at the moment. What are you looking at? Long Kiwi. 61.21 you're looking at profit, I assume, not 60.21. So you want to get above this 10 area, 10.11 area to get that. But that's looking pretty similar to the Aussie as well. You know, at these levels, we're breaking, then finding the support, breaking, finding the support, but we're just running a bit too far. So the market's taking a little bit of a pause into this one. Same situation, Ali. If you're in profit into the NFP, think about maybe taking some money off the table and see what happens over that. So what are you on about, Simon? 8 out of 10 central bankers expressed a preference for a kitty cat. Gavin, yeah, Jordan was out the other day saying the same old waffle, so I haven't paid too much attention to that. And the vice chair, as you say, cannot rule out further tightening of monetary policy to ease price stability. Their next meeting isn't until, I shall tell you, it's June. So it's 22nd of June, the S&B's next meeting. And the market's looking, on the probabilities, looking for a 25 pip hike over a 50. So yeah, 22nd of June. Good news though, folks. The Fed go into their blackout period tomorrow, so we'll all go nice and quiet. And then next Thursday, the ECB tighten the zip as well. So we get, I love it when they all go into their quiet period.
They've been really chatty over the past 2 or 3 years, right? Really
it's incessant, isn't it?
It's
part of their communications drive to make sure everyone knows what they're doing. And you know, it's all mainly for the public. Remember, it's not for us; it's for the public to show what they're doing. But obviously, we hear every line of it and charge you bonkers, charge you absolute bonkers.
Ryan, one thing I want to say regarding markets before I forget, I really do hope. Hold on. 1 second. All right. I hope that people have been listening. We've been saying for a while that it's really not looking good to be short risk and to be short equity indices. And personally, as soon as I woke up and saw the news, because remember, I'm in Greece, I'm not in the US. As soon as I read the news about debt ceiling, I bought a little bit, not a lot, a little bit of S&P at 42.31. And I think we're going to 4,300 and above. So, Jesus, what's happening with the phones today?
It's central bankers phoning you up, mate. They heard you were starting up your own central bank yesterday.
Yeah. So I really think, the S&P is breaking above highs, and I really would not want to be short here. So I'm just going to reiterate this one more time. Yes, maybe we get a dip or something, but maybe on the NFPs. But I don't see equities going lower, at least not any meaningful way yet. I will be a bear at some point, but price action is telling us the opposite. Just want to say it one more time. Hopefully people have not been caught short and in pain.
Yeah, good shout, mate, and nice grab. Got yourself a bit of margin there. As Gavin says, that phone call might have been a margin call. But yeah. So yeah, I hope you get your 43s, mate. That'll be very nice indeed. Very nice indeed. What will you do with that over the NFP? Will you tighten up your stops or something, or are you happy to let that one run?
Well, I have put my stop at entry now, so it's about 11 points. I know it's tight. If the NFP comes good, I'm sure I'm going to get taken out at flat, and I'm just going to leave it and see price action. Maybe I get long again. But I'm basically, the way I'm playing this is that if it's a weak number, there's no question that it's going higher. If it's a strong number, well, it depends on a lot of things. I might get taken out. Okay, so worst case scenarios, I get taken out at flat. I like that. So that's how I'm doing it now. And my target is about 4,300. I'm probably going to put a take profit just below there, in the maybe high 80s or something like that. So, nice little trade here and there. That's, keeps the doctor away. No, what's the saying?
Yeah, it is. Keeps the doctor away. A pip a day keeps the doctor away. I'm sure it's an apple, but we got that a bit of old form of resistance, support and resistance up that 42.70s area. Seen a bit of traffic area, and then obviously that big 43.10 as you mentioned. So yeah, I hope you get it, mate. Let's
yeah.
to take that fib out for starters. We can redraw that one later. Also keep an eye on yields, what's going on there. We did have the little flush under 3.6% yesterday. I know Steele's been talking about this, Dale's been talking about this, I've been talking about this. I was looking to see if we got a last little dip under there on the confirmation of the debt stuff, just a bit more of that risk premium washing out. That looks to have happened, and we've stabilised back around this 3.6% mark. So I think we're in a new chapter here, and for yields, the market is now going to want to see the data and what it means for the Fed. Part of this move, obviously, was those Fed expectations changing. You know, we shouldn't expect big moves in markets. You know, the market's flipped from hawkish to neutral on the Fed, and yet, you know, pairs like euro dollar have only moved, you know, 60, 70, 80 pips. So don't think that central bank changes and expectation changes are going to bring hundreds and hundreds of pips, because we're really sort of tinkering around the edges here. This is the difference between the Fed hiking 25 or not hiking. Ali's just asked about when will we get Fed cuts. We're not going to get Fed cuts till a long way down the line. But if the data continues to go south on inflation, you can betcha the market is going to start ramping up those Fed cuts and expectations, and they're going to be saying the Fed are going to have to cut sooner than they are telling us, and we're going to be playing that game. But again, rates aren't going to go to zero. We're not talking about rates going from 5% to zero again. They may come down very slowly. They may come down to a neutral rate, which is yet to be decided, which is probably going to be somewhere 2.5%, 3%. That'll be the level central banks want to get rates down to and keep rates at. So you're only talking about 200 basis points of cuts to come. That's not the same as cutting back to zero. That's not the same as when we went from 0 to 5%. So don't expect us to be getting thousands of pips moves. Don't expect to see dollar yen doing exactly the opposite to what it did all the way from the 100s up to the 150s. That's not going to happen unless, of course, the Bank of Japan suddenly pull out some stops and go mega hawkish. So it's all about context and knowing how the size of moves we're potentially going to get. So from here, you know, yields are going to be important. If we get strong wage data, then I expect yields to rally, dollar to rally, as said. If we get a good NFP, weak data, it's going to be interesting to see if yields want to go lower, or are we finding a bit of bottom? Are we saying that the market in terms of bonds is pricing what's expected from the Fed around this level, 3.58? Also keep in mind, looking at the short-term yields, because that's where you're going to see the pricing for cuts and stuff. So the 2-year yield still well below the Fed rates at the moment. Even the 1-year yield still holding above the current midpoint. So it's still buying into the higher for longer rhetoric there from that one. The 1-month yield we were looking at has washed out a lot of the premium now from the debt ceiling stuff. Again, this isn't a very liquid market. But as you can see, we're now trading 5.26% rather than up in the 6%. These were the bonds that were carrying over the debt ceiling stuff. So the risk premium has come out of the bond market for now. We're now trading the fundamentals again. Any other questions for you guys and girls before we look into it? Ali, what is the next market shove after debt ceiling? Yeah, well, just as mentioned, it is going to be cuts, but we're going to be now trading the data and stuff like that. Gold, you want to have a quick look at? Stell, did you look at gold? I don't want to go over old ground.
No, I didn't have the time to look at much. You were back quite quickly, so I haven't looked at
No worries, mate. So obviously we've got a bit of a level in here, 1985. Again, similar story. We found the low. We've broken up back through the prior break points. A bit messier. Not as clean as you might like, but up here, 109, what 1980s, 85 is your level. Get that. We're looking at the 2000s again, and maybe a push up to the highs. I'm not keen on trading gold at the moment because I've been a bit unclear as to why it's been moving. You know, if inflation's coming down, gold shouldn't be going higher. If the rule of thumb is to be respected. What are your thoughts on that, Stel? If the market's thinking that inflation's coming down, why is gold holding up?
Well, if inflation is going down, it means that the Fed will stop hiking. That's what's driving things, and that's, I've talked about it so many times. It's perverse. I mean, inflation is going higher. Dollar-denominated assets should be going higher, and gold should be going higher. Oh, Jesus Christ, seriously, no. And that's how it used to be. But now, when you get inflation going higher, the immediate reaction is, oh my God, they're going to be hiking, tightening, so this is bad for metals, and they get sold. So now it's the opposite. You know, they're going to be, inflation is going low, which means that they're not going to be tightening. Maybe they're even going to be cutting, which is good for metals because, you know, more liquid in the, you know, cheaper money, etc., etc. My opinion, I've shown in a chart in the chat room many times. If you overlay gold and the money supply, M2 money supply in the US, the chart is a perfectly correlated. Of course, gold goes up and down away from the line. You know, money supply goes up and gold goes up and down, but it follows. So for me, the main driver for metals, assuming supply and demand is steady, which it isn't, there's more demand now, but still assuming it's steady, the main driver is money supply. The end. You know, that's what I think. So that's why I think gold is still doing well, even though inflation is dropping, because it's implying a more dovish Fed and maybe even cuts coming.
So what about on the other side of the coin as a commodity? You know, with all these manufacturing numbers looking really poor, it's holding up on that as well.
You mean silver now?
Actual physical demand might be lower. Well, you know, there's demand for gold as well, but are you saying that's where you're seeing it mostly in silver?
Yes. I mean, silver is obviously greatly affected by the economy because it's an industrial metal, but it's just it's still the main driver for silver is as a precious metal and not as an industrial that much. This is going to change, I think, because new technology and, you know, all this new EV stuff and the solar panels and all that, that's going to become a lot more prevalent in the world, I think. So that's going to be driving silver more in terms of an economic metal, but I think at the moment is driven a lot more as a precious metal, you know, meaning same thing as gold. But you know, make no mistake, my view is that they're going a lot higher, and silver has a lot more to catch up. And you know, I'm long, you know it, in the low 23s. I'm still in the money now. I'm well in the money now, nicely, and I'm just running it. So.
Yeah, happy days, mate. Happy days.
Yes.
I'm gonna compound our pain by having a quick look at Euro NOK. Which is now
Ryan. I'm really sorry. I have to jump. I'm really sorry. I'm being bombarded by things which are quite important. So I'm going to leave you, and I'll see you in the chat room. Okay.
Yeah. No worries, mate. Thank you very much.
Thank you, everybody. Thank you.